Most of us had a piggy bank when we were kids. The idea was really simple. Keep putting small amounts of money into your piggy bank, and when a rainy day comes along, the money will still be sat there waiting for you. For a lot of people, this idea of keeping your money safe sticks with them into adult life. However, your bank account isn't a safe deposit box. The bank doesn't take your money, carry it down to the vault and put it in a box with your name written on the front. And it doesn't store it in any digital equivalent of a safe deposit box either. What actually happens is that when you put money into a bank, that money becomes the property of the bank. Because it becomes their property, the bank can use it for effectively anything it likes. But what are those numbers that appear in your account? Is that not money? In a legal sense, no. Those numbers in your account are just a record that the bank needs to repay you at some point in the future. In accounting terms, this is known as a liability of the bank. So the balance of your bank account doesn't actually represent the money that the bank is holding on your behalf. It just shows that they have a legal obligation or liability to repay you the money at some point in the future. Banks take money from savers and lend it to borrowers. Banks borrow money from people who want to save it, such as pensioners and wealthy individuals, and they then use that money to lend it to people who need to borrow, such as young families that want to buy houses or small businesses to invest and grow. The banks make their money by charging the borrowers slightly more in interest than they pay to the savers. The difference between the interest rates, known as the spread, makes up their profit. In this model, banks just provide a service by getting money from people who don't need it at the time to people who do. Money is generated through the process of fractional reserve banking. You can think of money as having two origins. First, base money or outside money. This is the currency, or the reserves, that are created by the central bank, and deposit money or inside money, which is generated through the process of fractional reserve banking. So what is fractional reserve banking? Imagine, a man walks into a bank and deposits his salary of $1,000 in cash. Now the bank knows that, on average, the customer won't need the whole of his $1,000 returned all at once. He's probably going to spend a little bit of his salary each day over the course of the month. So the bank assumes that much of the money deposited is idle or spare and won't be needed on any particular day. It keeps back a small reserve of say 10% of the money deposited with it, in this case $100, and lends out the other $900 to somebody who needs a loan. So the borrower takes this $900 and spends it at a local car dealer. The car dealer doesn't want to keep that much cash in its office, so it takes the money back to another bank. Now the bank again realizes that it can use the bulk of the money to make another loan. It keeps back 10%, $90, and lend out the other $810 to make another loan. Whoever borrows the $810 spends it, and it comes back to one of the banks again. Whichever bank receives it then keeps back 10%, that is $81, and makes a new loan of $729. This process of re-lending continues, with the same money being lent over and over again, but with 10% of the money being put in the reserve every time. Note that every one of the customers who paid money into the bank still thinks that their money is there, in the bank. The numbers on their bank statement confirm that the money is still there. Even though there is still only $1,000 in cash flowing around, the sum total of everyone's bank account balances has been increasing, and so has the total amount of debt. Supposedly this process continues until only a penny is being relent. By now, the sum total of all bank accounts adds up to about $10,000. If the Federal Reserve were to lower reserve requirements, that would ordinarily allow banks to lend out more money, which would create more deposits, which would allow the fractional reserve banking system to create an increasing quantity of money in circulation. Conversely, if the central bank increases the reserve requirement, the process will work in reverse. Deposits will be contracted, and the money supply will shrink. However, in the real world, banks may take it upon themselves to issue a loan and then seek out reserves from other financial institutions, central bank or private individuals. Banks make loans first and worry about reserves later. Whenever a bank makes a loan, it simultaneously creates a matching deposit in the borrower's bank account, thereby creating new money. As the bank usually made long-term loans funded by short-term deposits, they were always at risk of a bank run, which is where FDIC insurance came in. All the deposits are insured by the FDIC, so that the depositors can withdraw their money anytime. So what if more money like these is printed? Here is a simple example to explain why printing money causes inflation. Suppose the economy produces 1,000 units of output, and the money supply total number of notes and coins equals $10,000. This means that the average price of the output produced will be $10. Suppose then that the government print an extra $5,000 notes, creating a total money supply of $15,000. But the output of the economy stays at 1,000 units. Effectively, people have more cash, but the number of goods is the same. Because people have more cash, they are willing to spend more to buy the goods in the economy. If you print more money, the amount of goods doesn't change. However, if you print money, households will have more cash and more money to spend on goods. If there is more money chasing the same amount of goods, firms will just put up prices. So here is a question for you guys. Will trillions of stimulus dollars ignite inflation? What's ahead? Thanks for watching. Please subscribe to our channel and press the bell icon for more awesome content.